Hello and welcome to our video on the collapse of Silicon Valley Bank. This collapse is another setback for the tech industry and is the biggest bank failure since Washington Mutual in 2008. Here's what happened to SVB and how it may affect tech companies and startups moving forward. What is Silicon Valley Bank? SVB was founded in 1983 and was the 16th largest U.S. bank before its collapse. They specialized in financing and banking for venture capital-backed startup companies, mostly technology companies. Venture capital firms did business there as well as several tech executives. Why was SVB important to the tech sector? SVB provided financing for about half of all U.S. venture-backed technology and healthcare companies. SVB was a preferred bank for the tech sector because they supported startup companies that not all banks would accept due to higher risks. Why did it collapse? The collapse happened for multiple reasons, including a lack of diversification and a classic bank run, where many customers withdrew their deposits simultaneously due to fears of the bank's solvency. Silicon Valley Bank invested a large amount of bank deposits in long-term U.S. Treasuries and agency mortgage-backed securities. However, bonds and Treasury values fall when interest rates increase. When the Federal Reserve hiked interest rates in 2022 to combat inflation, SVB's bond portfolio started to drop. When economic factors hit the tech sector, many bank customers withdrew money as venture capital started drying up. SVB didn't have the cash on hand to liquidate these deposits because they were tied up in long-term investments. They started selling their bonds at a significant loss, which caused distress to customers and investors. Within 48 hours after disclosing the sale of assets, the bank collapsed. When SVB announced their $1.75 billion capital raising on March 6, people became alarmed the bank was short on capital. Word spread quickly on social media accounts such as Twitter and WhatsApp, inducing panic that the bank didn't have enough funds. Customers started to withdraw money in waves. SVB's stock plummeted by 60% on March 7 after its capital raising announcement. Some people are saying the bank run was Twitter fuel. Who was affected by the collapse? SVB stockholders and investors took a big hit because, unlike customers, they were not backed by FDIC on their investment. Other issues include a lack of money from deposits for immediate expenses such as payroll. Large tech companies with significant cash in SVB include Etsy, Roblox, Rocket Labs, and Roku. First Citizens Bank purchases Silicon Valley Bank. On March 26, 2023, FDIC announced First Citizens Bank will purchase Silicon Valley Bank and assume the majority of its deposits and loans. As of March 10, Silicon Valley Bank reported nearly $167 billion in total assets and $199 billion in deposits. First Citizens Bank will purchase about $72 billion in assets at a discounted rate of $16.5 billion. FDIC will remain in control of nearly $90 billion in assets and securities in its receivership. The FDIC also estimated that the SVB failure cost nearly $20 billion. In addition to Silicon Valley Bank, other banks were facing solvency issues such as Signature Bank and Credit Suisse. UBS agreed to buy out Credit Suisse for $3 billion Swiss franc. This collapse is a reminder of the importance of diversification and the need for companies to have backup plans. Thank you for watching, and please let us know your thoughts in the comments below.